Hi students, welcome to my channel. Let's start the revision series of CA Inter Advanced Accounting. And first we started with consolidation of financial statements and one of the high scoring topic and one of the important topic from the exam point of view. And majority of the students feel very difficult in this topic. If you follow the simple steps and the logic behind these steps, and you will feel some better in the final examination relating to this topic. And from this topic, you can expect at least one question, minimum one question, nothing but for 14 marks. And sometimes you may have one MCQ or two MCQs from this chapter also. Okay. And before that, before moving on to the topic, so if you are new to my channel, please subscribe it and watch the entire video without any skipping. Because in this series, I'm not only discussing the concept and also I will try to explain the few important questions from the exam point of view so that you will feel better relating to the topic in the examination. So if you like the video, please press the like button and share it to your friends. And whatever the material I used in this explanation, I will provide it in the Telegram channel. And the link will provide it in description box. And please join that one. And so that you can download this material from the Telegram channel and some MCQs and case-based scenarios and some practice questions also I will provide it through the Telegram channel. Okay. If you want to connect with me, then you can connect freely through the Telegram channel or you may give the comment below this video. Okay. And after watching the entire video, so please give me one comment below the video how you liked it. Okay. So without wasting the time, I will move on to the topic directly, consolidation of the financial statement. So coming to the consolidation, and first of all, before that, as per Section 129 of Companies Act 2013, a holding company is required to prepare two set of financial statements, and one is separate financial statements, and another one is consolidated financial statements. Separate financial statements are nothing but the financial statements consisting of the financials of holding company only. Only financial data relating to the holding company are considered while preparing separate financial statements. But coming to the consolidated financial statements, these are the combination of holding company and its subsidiary company financials. And it means it consider financials of both holding company and its subsidiary company also. So, holding company is required to prepare two set of financial statements as per section 129. One is separate financial statement, and that means it's standalone financial statements, and the second one is consolidated financial statements. Okay, consolidated financial statements are consisting of the financials of both the parent and means holding company as well as its subsidiary company. Okay, and normally financial statements consisting of five components, and one is the balance sheet, another one is profit and loss statement, another one is cash flow statement, and statement of changes in equity and notes to account. And same way, in case of consolidated financial statements, it consisting of four elements. One is the consolidated balance sheet, consolidated profit and loss statement, and the consolidated cash flow statement and notes to accounts. But consolidated cash flow statement is not in your syllabus, and only balance sheet and profit and loss statement are in syllabus. Okay. And in this consolidated financial statement, three standards covered. One is the AS-21, AS-23, AS-21. 21 is relating to the consolidated financial statements of subsidiary companies. And AS-23 is relating to the consolidated financial statements for investment in associates. And AS-27 is relating to the consolidated financial statements relating to the investment in joint venture. Okay. And before moving, and in this series, in this session, we'll discuss entire topic relating to AS-21. Only AS-21 will cover in this lecture, and AS-23 and 27 will cover in another lecture. Okay. And before moving on to the topic directly, and first we discuss some important definitions relating to the chapter. Okay. And first of all, what is the parent company? What is the parent company? Parent company is nothing but the company or the enterprise or the entity which is having the control over one or more subsidiaries, which is having the control over one or more subsidiaries is said to be a what parent company. For example, A Limited, A Limited hold the shares, hold the shares in B Limited. Then when the A Limited is said to be, when the A Limited is said to be having the control over B Limited. So, if the A Limited is having the control over B Limited, A Limited is said to be a what parent company or holding company, and B Limited is treated as a subsidiary company. B Limited is treated as subsidiary company. But how the A Limited will get the control over B Limited? For getting the control, two options are there to A Limited. And one is directly through the shareholding pattern. If A Limited acquire more than 50% of equity shares of B Limited, more than 50% of equity shares of B Limited, then A Limited is said to be what control over B Limited. First point. And second one is if the A Limited is having the control over B Limited through the board of director composition. Through the board of director composition. For example, A Limited hold 30% shares in B Limited. As per the definition, more than or equal to 51% is said to be what having the control over that company. But here A Limited acquired only 30%, means A Limited is not having the control over B Limited. Then we'll verify the second point. What is the second point? Will the A Limited have the control through the board of director composition B Limited? For example, in B Limited, total 8 directors are there. 8 directors. But out of that, 6 directors will be appointed with the approval of A Limited only. 6 directors are appointed with the approval of the A Limited. Then A Limited is said to be controlled over the majority number of the directors in B Limited. So A Limited is said to be what control. Control may be obtained by the parent company either through the shareholding pattern or through the control through board of director composition. Through what board of director composition. Okay. And another one, for example, here A Limited is having 80% in B Limited and 40% in C Limited, and is also 30% in D Limited, and also it involves in one joint venture. And the combination of this one, that means here A Limited is said to be having the control over B Limited because it is holding more than 51% of equity shares of B Limited. Then A Limited is said to be having significant influence over C Limited and D Limited. So when we get the significant influence, if you are holding more than or equal to 20% of the equity shares of another company, then first company is said to be having the significant influence over another company. In that case, C Limited and D Limited are treated as associates to A Limited. And here, A Limited in joint venture with another company. So the combination here, A Limited is said to be a what holding company, and the whole group A Limited and its subsidiaries and its associates and the joint venture. This combination is said to be a what group companies. This is said to be a what group company. Group company consisting of what one holding company and its subsidiaries and its associates and its joint venture, and all are combinedly called as what group company. Called as what group company. Okay, and here another thing is subsidiary company. Subsidiary company is nothing but the company or the entity which was under the control of another entity is said to be our subsidiary company. And in the previous example, A Limited acquired 80% shares of B Limited. Then A Limited is said to be having the control over B Limited through the holding of the shares. There, A Limited is treated as a parent company or holding company, and B Limited is treated as what subsidiary company. Okay, treated as what subsidiary company. And one more point is, for example, here A Limited acquired 80% shares of B Limited. 80% shares of B Limited. So in B Limited, in B Limited, in B Limited, 80% shares are acquired by A Limited. Then what about the remaining 20%? This 20% is not held by A Limited, not held by A Limited. So this portion, which was not held by the parent company, the portion of the equity shares, which was not held by the parent company, is called as minority interest. Is called as what? Minority interest. What is meant by minority interest? The portion of the equity shares or the percentage of that equity shares which was not held by the parent company, which was not held by the holding company, is it treated as what? Minority interest. Is called treated as what? Minority interest. Okay. And these are the few definitions. What is meant by parent company? And what is meant by control, what is meant by subsidiary company and group company, how one company get the control over another company, and what is meant by minority interest. These are the simple definitions we require to learn in the consolidated financial statement. And coming to here, then how we prepare the consolidated financial statements and what are the steps we have to follow while doing the consolidation financial statement. And before going to the procedure, first we'll discuss few examples to understand how we are going to prepare consolidated financial statements. Okay. And first of all, just imagine here A Limited acquire 80% shares in B Limited. 80% shares in B Limited. Then A Limited is said to be a what? Holding company. And B Limited is said to be a what? Subsidiary company. B Limited is said to be a what? Subsidiary company. A Limited is said to be a what? Holding company. And B Limited is said to be a what? Subsidiary company. Then, as per Section 129, A Limited is required to prepare two set of financial statements. One is separate financial statements, and another one is consolidated financial statement. In separate financial statements, what is the entry recorded by A Limited? A Limited will record entry what? Investment in, they purchase what? Equity shares in B Limited. That is an investment to A Limited. So that's why while purchasing the investment, what was the entry to be recorded? Investment account debited to cash or bank. And they wrote the same entry, investment in B Limited account debited to cash or bank account. That is the entry they recorded. But coming to the B Limited does not record any entry. If the shares acquired by A Limited in the B Limited, then no entry will be recorded by B Limited. Because remember, A Limited is not purchasing the shares from the B Limited. A Limited is purchasing the shares from the equity shareholders of B Limited. So A Limited pay the amount to the equity shareholders of B Limited, not to the B Limited, not to the B Limited. That's why no cash flows involved here and no change in assets or liabilities involved here. That's why in B Limited, no entry is recorded. And coming to A Limited, already we discussed in separate financial statements what was the entry to be recorded. Investment in B Limited account debited to cash or bank account. But as per Section 129, along with the separate financial statements, one more financial statements required to prepare by holding company is nothing but what? Consolidated financial statement. And first of all, what is meant by consolidation? Consolidation simply is nothing but aggregation of each and every item on line by line basis by way of eliminating similar nature of transactions is said to be a what? Consolidation. So consolidation is nothing but aggregation of each and every item on line by line basis by way of eliminating similar nature of transactions is said to be a what? Consolidation. Said to be a what? Consolidation. And it means what? For example, here, so here A Limited and B Limited. A Limited assets are there, B Limited liabilities are there, A Limited assets, B Limited liabilities, and its equity. And its equity. So, for example, here A Limited acquired equity shares of B Limited. Then A Limited is required to prepare what? Separate financial statements as well as consolidated financial statements. In consolidated financial statements, what we do simply A Limited assets plus B Limited assets, A Limited liabilities plus B Limited liability. Simply, we have to add the each and every item on line by line basis by way of eliminating what? Similar nature of transactions. And what is meant by elimination of similar nature of transactions? I will explain it here. And here, for example, B limited, A limited. So here the two financials are given relating to A limited and B limited. On 1/4/2000 A Limited acquired 100% shares in B Limited. And what is this mean? Here there is no minority interest because 100% held by A Limited only. 100% held by A Limited only. There is no minority interest. Then in the books of A Limited, so it purchased 100% share. The total share capital of B Limited acquired by A Limited for how much amount? 2 lakhs. Then, in the books of A Limited, already I told you, in the books of A Limited means in separate financial statements, they record the entry what? Investment in B Limited account debited to cash or bank. But coming to the B Limited, no entry is recorded because the transaction happened in between A Limited and the equity shareholders of B Limited, not with B Limited directly. So, no entry will record in the books of B Limited. Then, coming to the separate financial statements, A Limited recorded in this way. Their financial statements are represented as equity share capital, liabilities, PPA. On the asset side, one more item has been added in the books of A Limited, nothing but investment in B Limited, and we recorded this entry. But there is no change in financials of B Limited. Okay. Then, what will be the impact in consolidated financial statements? In consolidated financial statements, what is meant by consolidation? Adding of each and every item on line by line basis by way of eliminating similar nature of transactions. And what we do here, equity share capital. A limited equity share capital plus B limited equity share capital. A limited liabilities plus B limited liability and total. And PPE, A limited PPE plus B limited PPE. And A limited investment plus B limited investment. And A limited current assets plus B limited current assets. Okay. Aggregating of each and every item on line by line basis by way of eliminating similar nature of transactions. Here, what are the similar nature? Here, investment in B Limited is representing in equity share capital of B Limited. Okay. Investment in B Limited is representing what? Equity share capital of B Limited. So those items are required to be eliminated while aggregating each and every item on line by line basis. But here we have to reduce what? 2 lakhs. And from the investment, we have to reduce what? 2 lakhs. And this is what? Consolidated financial statement. In consolidated financial statement, simply what we do? Aggregating each and every item on line by line basis by way of eliminating what? Similar nature of transactions. By way of eliminating similar nature of transaction. That is simply nothing but what? Consolidation. And here the rule is adding each item on line by line basis. On line by line basis by way of eliminating similar nature of items. So here 5 lakhs plus 2 lakh. What is the similar nature here? The equity share capital of B Limited is represented as investment in B Limited. So these were cancelled. These were cancelled. So only equity share capital of A Limited are reflected in consolidated financial statement. And the liabilities, A Limited liability plus B Limited liability. PPE, A limited PPE plus B limited PPE. Investment, A limited investment plus B limited investment minus similar nature of items are nothing but what? Equity share capital of B limited, nothing but 2 lakh. That's why it is 0. So current assets, A limited plus B limited. This is simply nothing but what? Consolidated financial statement. Okay. Then, so here we discussed 100%. We discussed what? 100, in case of 100% hold by the A limited. For example, hmm, for example here, for example, A Limited, hmm, so here A Limited uh, acquired the shares of B Limited. A Limited acquired the shares of B Limited. Here, investment in B Limited is meant for 2 lakhs, and equity share capital is also what 2 lakhs. Equity share capital is also what 2 lakhs. For example, investment is made for 3 lakhs. Okay, 2 lakh equity shares of B Limited acquired by A Limited for 3 lakh. This 3 lakh is representing 2 lakh equity share capital. 2 lakh equity. This 3 lakh is representing what 2 lakh equity. So if more than the equity you are paying, actual total equity of B Limited is 2 lakh. But the total equity you acquired, 100% equity shares of B Limited you acquired. But you acquired that amount for how much amount? 3 lakhs. And you are paying more than what you get. You are paying what? More than what you get. And you are paying more. And that means, is it a profit or loss to you? Means that is a capital loss. In that case, what we do? In that case, what we do? For example, in this scenario, so here A Limited 5 lakhs plus 2 lakhs. So A Limited is how much? 5 lakh plus 2 lakh. So in case of in the consolidated financial statement, what we do here 5 lakhs, and this was cancelled with this one. But actual investment in B Limited here is how much amount? 3 lakhs. So, but only 2 lakh was cancelled. Only 2 lakh was cancelled. And 1 more lakh you are paying more. 1 more lakh you are paying more. And whatever the excess amount you paid more is treated as a capital loss, and the capital loss is transferred to what? Goodwill. Capital loss is transferred to what? Goodwill. How you represent here? So here equity share capital only A Limited holding company share capital we consider 10 plus 3, 13 lakh here, and PPE 7 plus 2, and 9 lakh we consider. And here investment sorry, in case one more item is required to be added is nothing but what? Goodwill. Is nothing but what? Goodwill. So and investment is cancelled with B Limited, and excess amount is represented here on the asset side in terms of what? Goodwill. And here the cost of investment is more than the equity of a subsidiary company, then that is a capital loss to you, and is represented on asset side in the form of what? Goodwill. And one more possibility we have, the cost is less than equity of the subsidiary company. Means you are paying less amount than what you are getting. In that case, that is said to be a what? Capital profit. And that is transferred to separate account called as what? Capital reserve. Nothing but what? Capital reserve. So three possibilities are there. The entire equity of the B Limited you are purchasing here in this scenario, 100% equity we are purchasing. And that 100% equity, what you are purchasing at what price? The price you paid is equal to benefits you get or equity you get. Then there is no profit, no loss. Price you paid is more than the equity you get. Then that is a loss to you, and that loss is treated as capital loss and is transferred to goodwill. And the third one is price you paid is less than the equity you get, then that will be the profit to you and is nothing but capital profit and is transferred to separate account called as capital reserve. Capital reserve. Okay. And this is the one case. Then I will explain it in another case where we have so minority interest. Okay. In this scenario, for example, here A limited balance sheet we have here, B limited balance sheet here. On 1/4/2000 X1, A limited acquire 80% of the shares in B limited at 1,60,000. And out of the 2 lakh, entire portion was not acquired by A limited. Out of that, 80% of the shares only acquired by A Limited, and that 80% acquired for 1,60,000. And one more item we have is nothing but what minority interest for 20%. Minority interest for 20%. Then how you consider? And as we discussed in the books of A Limited is required to prepare two set of financial statements. One is separate financial statements, another one is consolidated financial statement. In separate financial statement, first of all, in the books of A Limited, while purchasing the shares, they wrote the entry what investment in B Limited account debited to cash or bank 1,60,000. This is the one. And as we discussed in the books of B Limited, no entry is recorded because the transaction is made between A Limited and the equity shareholders of B Limited, not with B Limited directly. And this is the status of separate financial statements coming to A Limited. Investment is 1,60,000 and the cash balance is reduced by 1,60,000. So cash will be changed as 6,40,000. Then coming to the consolidated financial statements. Coming to what? Consolidated financial statements. What we said, the adding of each and every item of on line by line basis by way of eliminating similar nature of items. And here, as we discussed, the equity share capital is representing only equity shares of A Limited, nothing but holding company we consider. Coming to the liabilities, 10 plus 3. So that is considered. PPE 7 plus 2 is considered. Investment is required to be cancelled. Investment is required to be cancelled with B Limited. But in the B Limited, 80% only cancelled with investment. But in the equity shares of B Limited, 20% more is there, which was not held by the holding company. That is representing what minority interest. And it means out of the total, for example, you are purchasing the 80% of equity shares means what? Out of the total net assets, equity and means what? Net assets. So 80% of the net assets you are acquiring. But while doing the consolidation, what we do, entire items has been added. 10 lakh plus 3 lakh, 7 lakh plus 2 lakh, 6 lakh 40 plus 3 lakh. In this way, you are holding 80%, but while doing the consolidation, you are adding 100% net assets of B Limited with A Limited. That means what? You are holding only 80%, majority of the shares you held, but through the majority of the shares holding, you are getting 100% control over subsidiary company. 100% control over subsidiary company. That is the reason why AS-21 is recommended to follow full consolidation method. Full consolidation. Proportionate consolidation method is not recommended as per AS-21. Even though you are holding 80%, so no need to follow the proportionate consolidation method. Proportionate consolidation means what? A 10 total A limited assets plus 80% of B limited assets. The total A limited liability plus 80% of B limited liability. If you are adding in that way, that is said to be proportionate consolidation. But AS-21 is not recommending that. We have to represent and we have to consider entire net assets of the B limited. Entire assets, 100% assets have been added, even though you are holding 80% or more than 51%, but up to 100%. So in that case, you are adding what 100% net assets of the company. But out of that, your portion is restricted to 80% or 20% you liable to pay to another party that belongs to another party. That's why that 20% part is representing on the liability side as what minority interest, which was not held by the parent company. Which was not held by the parent company. So in this case, out of the 2 lakh, 80% is represented with the investment. Those are cancelled. Out of the 2 lakh, 80% is only cancelled. And another 40,000 is there. That is representing what? 20%. Relating to the 20%, no similar item is there in the A limited because it was not held by A limited. That's why we have to represent it as a separate line item as it is not belongs to the A limited, that belongs to the other and some obligation we have. That's why we show it on the liability side of the balance sheet. Okay, I hope you understood. So if any minority interest we have, so in that case also we have to add assets and liabilities of subsidiary company 100% in the consolidated financial statements with the holding company assets and liabilities. And as per along with that, one more line item will be added, nothing but what minority interest. Minority interest is required to be shown and after the equity in financial statements. Okay. And coming to the next example, D. Balance sheet of A Limited and B Limited are provided. It's individual financial statement. On 1/4/2000 X1, A Limited acquired 80% of the shares in B Limited. It means what? Here actually in the B Limited, 80% acquired by A Limited. And it means 20% is nothing but what? Minority interest. And 80% means what? Out of the 2 lakhs, 80%. 1,60,000. 1,60,000. But for 1 lakh, for getting the 1,60,000 equity of B Limited, you are paying how much amount? 2,50,000. And you are paying more than what you are getting. Then that excess amount, how much amount is that? 90,000. 2,50,000 minus 1,60,000, 90,000. That excess amount you are paying to the equity shareholders of B Limited is nothing but capital loss to you and is represented as goodwill in the consolidated financial statements on asset side of the balance sheet. Okay, right. So then coming to this same scenario, and first, in the separate financial statement, they noted it. A Limited will first record the entry what investment account debited to cash or bank. And as per AS-13, and when the investment you purchase, it is recorded at cost price only. In the books of B Limited, no entry is recorded because the transaction is made between holding company and the shareholders of a subsidiary. So not with the subsidiary company directly. Then in the separate financial statements, one item is added in the holding company books, nothing but investment in B Limited, and along with that current assets means cash has been affected. Cash is decreased by 2,50,000. Then coming to the consolidated financial statements, what we record. And here out of the 2,50,000, 1,60,000 is cancelled with equity shares of B Limited. Okay. First in consolidated financial statements, what we record here. So only holding company equity. But coming to the 2,50,000, this is representing 80% of equity shares of B Limited. And 80% of equity shares means 2 lakh into 80%, 1,60,000 only. The remaining 40% not held by A Limited, that is represented as what? Minority interest. So minority interest is represented as how much amount? 40,000. And liabilities 10 plus 3 and PPE 7 plus 2. And one more item is added here is nothing but what? For getting the 1,60,000 worth of equity, you are paying 2,50,000. Excess amount you are paying. Nothing but what capital loss to you and is transferred to what? Goodwill. Goodwill is 90,000. And this 1,60,000 portion is cancelled with equity shares of B Limited 1,60,000. And excess amount you are paying is continued as a goodwill. And the current assets. In the remaining investment is zero. Current assets 5.5 plus 3 lakh. And this is what consolidated financial statements. Okay, this is the one. And this is the minority interest. This is the what goodwill. The remaining every item will be added on line by line basis. Okay. And what we discussed till now, if the purchase consideration means what, how much, at what price you purchase that equity shares of subsidiary company. So cost of investment minus share in net assets. If the difference is representing goodwill or capital reserve, goodwill when we goodwill, if it is a capital loss, and if it is a capital profit, and we transfer to capital risk, and we transfer to what? Capital risk. Okay, I hope you understood. So what is meant by consolidation? Simply, consolidation is nothing but what? Adding of each and every item on line by line basis by way of eliminating similar nature of items from the financial statement. So consolidated financial statement. Then how to prepare the consolidated financial statements and what are the steps we follow? Simply 6 step procedure. 6 step procedure, and that 6 steps only we followed here. And coming to here, just first step one, note down what is the date of acquisition. Means what? The date on which holding company acquire the shares of a subsidiary company, and the date on which holding company get the control over subsidiary company. So remember, the date on which holding company get the control over subsidiary company is nothing but what? Date of acquisition. Second one is date of consolidation, date on which consolidated financial statements we are preparing. Is nothing but date of consolidation. And step one, note down date of acquisition and date of consolidation. And the second one is shareholding pattern of subsidiary company. Out of the total shares of subsidiary company, how much percentage held by holding company or parent company, how much percentage held by minority interest, you have to note it down. And another one is step three. So step one is date of acquisition, date of consolidation. Step two, shareholding pattern of subsidiary company. And step three is very important, very important step. You have to analyze the reserves and surplus of subsidiary company in such a way, divide in between pre-acquisition period and post-acquisition period. Pre-acquisition period and post-acquisition period. That means what? For example, A Limited acquired equity shares of B Limited on 1/4/2024. The period prior to the date of acquisition is called as pre, and the period after the date of acquisition is called as post-acquisition period. The period prior to the date of acquisition is said to be a pre-acquisition period. The period after subsequent to the date of acquisition is said to be a post-acquisition period. And whatever the profit you get in pre-acquisition period is treated as capital profit. They're treated as, because that is a profit not belongs to you. That is the profit not belongs to you. But whatever the profit you get after subsequent to the date of acquisition is said to be a revenue profit. This profit is belongs to you only. This is belongs to you only. So the entire resource and surplus are required to be segregated in between pre-acquisition period and post-acquisition period. And among the respected profit, what is the portion of parent company and what is the portion of minority interest? And you have to segregate general reserve, profit and loss account, another resource, if any, we have in between pre and post-acquisition period. And after that, out of the total pre-acquisition period profits, what is the percentage of parent company, what is the amount held by, amount belongs to minority interest. Same way in case of post acquisition period. So step 3 is analysis of reserves and surplus, and the reserves and surplus are required to be segregated in between pre acquisition period and post acquisition period. Out of that, out of the total profits, we have to calculate what is the amount relating to parent company, what is the amount relating to minority interest. This is the format. And step 4, and this step 3 is very important. And if you did any wrong in step 3, another steps will become wrong. And so this step 3 will be the base for another step. This is the magic step. And coming to this step 4, step 4 is nothing but cost of control, nothing but what. And here already we discussed in the process of consolidation. And while you are paying, so while you are purchasing the equity shares of a subsidiary company, how much amount you paid? So you pay how much amount you pay. For that, how much amount of equity you get on that day. So if you paid one amount, but you are getting the benefits, you are getting the equity of a subsidiary company, maybe less than amount you paid or more than amount you paid or equal to the amount you it reflects in what either capital profit or capital loss. So you need to calculate whether it is representing capital loss or capital profit. If it is a capital loss, we transfer to goodwill. If it is a capital profit, we transfer to capital reserve. So, and that calculation is covered under step 4. Step 4 is representing what cost of control. For getting the control, how much excess amount you require to pay to the equity shareholders of P Limited. So here, first we have to consider cost of investment. This cost of investment will be provided in the problem. Otherwise, from the holding company financials on asset side, investment in subsidiary company amount, you have to consider it as cost of investment if it is not provided. And another one is pre-acquisition period dividend received from subsidiary company. And you have this point is very, very important. And you have complete discussion about the point in even in AS-13 also, accounting for investment. So while purchasing the equity shares of B Limited, while purchasing the equity shares of B Limited, for example, A Limited acquired the shares of B Limited in the 23 to 20. And normally every company will provide the dividend in the subsequent period only. In the subsequent period. For example, you purchased it on 1/4/23. 1/4/23. So B Limited announced the dividend on 1st October 1st August 2023. So relating to the period 20 to 23. B Limited announced the dividend for the period 20 to 23 on 1st August 2023. And here the dividend has been announced subsequent to the date of acquisition, but the dividend is announced relating to the which period. And during this period, are you the holder of the respected shares? Means answer is no. Because we purchased it on 1/4/2020. During the period, we didn't hold. And during that period, who is the holder of the shares? Another party from whom you purchase. That means the dividend belongs to that person, not belongs to you, not belongs to the holding company. The dividend belongs to the another party from whom you purchase it. So while selling the shares by that another party, we assumed that that party also deemed to be collecting the dividend, and whatever the amount you paid to the equity shareholders of B Limited is said to be including dividend relating to that period. That's why any pre-acquisition period dividend received from the subsidiary company is required to be reduced from cost of investment, as we assumed that that was already included in cost of investment. Already included in cost of investment. Okay, so cost of investment first we have to consider. Out of that, you have to reduce what pre-acquisition period dividend received from subsidiary company. Then we get net cost of investment. And out of that, you have to reduce the holding company share capital and pre-acquisition period profits. And always remember the most important point is the cost of control is calculated only on date of acquisition. Only on date of acquisition. And means you are acquiring the equity on that particular day. And so you have to compare the equity you get on the day relating to the subsidiary company with the cost you spent for getting that equity. So what is meant by equity? Share capital of subsidiary company on the date of acquisition, profits of subsidiary, reserves and surplus of subsidiary company on the date of equity. Equity generally stands for two things: equity share capital plus reserves and surplus. So share capital of subsidiary company on the date of acquisition, reserves and surplus of subsidiary company on the date of acquisition. Out of the total, what is the parent company share? That is the equity you get on the date of acquisition. That is compared with the net cost of investment. If the net cost of investment is more than the equity you get, that is said to be a capital loss and is transferred toward goodwill. If it is negative, means the amount you spent is less than the equity you get. That is a capital profit and we transfer to capital risk. So this is very, very important step. And remember the point. First, we have to consider cost of investment. If the point is not given directly in the problem, take it from the balance sheet of holding company on asset side as investment in subsidiary company. Consider that figure directly. Minus pre-acquisition dividend received from the subsidiary company, if any. Then we get net cost of investment. And from that, you have to reduce parent company share in equity of subsidiary company only on what date? Date of acquisition. Then the question is, sir, subsequent profits are having the impact on cost of control. No, in the cost of while calculating the cost of control or while calculating goodwill or capital reserve, we didn't consider subsequent period profits anywhere. We consider only pre-acquisition period. That means the data up to the date of acquisition, what is the equity of the respected company. In some cases, equity, share capital, and reserves and surplus on the date of acquisition of the subsidiary company are not provided in the problem. In that case, you may consider what is the net assets of the subsidiary company on the date of acquisition. If the share capital and reserves and surplus of subsidiary is not given in the problem directly, then you consider what net assets of subsidiary company directly. Net assets of subsidiary company. I hope you understood. Four steps we completed. One is step one, note down the date of acquisition, date of control, date of consolidation. Second one, shareholding pattern of subsidiary company. The third one, cost analysis of reserves and surplus of subsidiary company by dividing it the total reserves and surplus of on the date of consolidation into pre-acquisition period profit, post-acquisition period profit, and among the total also segregate into parent company portion, minority interest portion in pre-acquisition period, parent company portion and minority interest portion in post-acquisition period also. And step four, cost of control means we need to calculate what is the goodwill or capital risk. First, we consider cost of investment. From there, you have to reduce any pre-acquisition period dividend received from subsidiary company, and that is the net cost of investment. Then, from there, you have to reduce what parent company share in equity of subsidiary company on the date of acquisition. What is the equity? Share capital of subsidiary company and reserves and surplus of subsidiary company on the date of acquisition. The reserves and surplus of subsidiary company on the date of acquisition called as what? Pre-acquisition period profits. If the share capital and the reserves and surplus on the date of acquisition is not given in the problem, just simply take it net assets of subsidiary company. I hope you understood step four. Okay, and this is the important discussion about the dividend. About the what dividend? So here, the dividend proposed by the subsidiary company or dividend proposed by holding company. If the dividend proposed by holding company, general for dividend, what is the journal entry? Profit and loss account debited to proposed dividend. If it is announced by holding company, in the books of holding company, what we record? Holding company profit and loss to proposed dividend. But if it is proposed by subsidiary company, if it is proposed by subsidiary company, always required to verify whether dividend announced is relating to pre-acquisition period or post-acquisition period, because pre-acquisition period dividend not belongs to us, that was already deemed to be included in cost of investment and required to be reduced from cost of investment, and don't transfer it to profit and loss account. Only post acquisition period dividend belongs to us, and we treated it as our income and we transferred to profit and loss account of parent company. Profit and loss account of parent company. Okay. So if any dividend received from subsidiary company relating to pre-acquisition period, reduce it from cost of investment. Reduce it from cost of investment. Already we discussed it in step 4, cost of control. If the post acquisition period dividend, if anything is received, then it is treated as our income and transferred to profit and loss account of parent company, that we discuss it in step 6. Nothing but consolidated reserves and surplus. Consolidated reserves and surplus. And this point is very, very important. So if the pre-acquisition period dividend received from subsidiary company, pre-acquisition period dividend received from subsidiary company. In that case, three possibilities are there. For example, in the problem it says, sir, no entry is recorded in holding company. Pre-acquisition dividend announced by subsidiary company and we receive this dividend also, but no entry is recorded. Then now record the entry. What is the entry? Cash account debited to dividend income. Cash account debited to dividend income. The dividend income we transfer to investment, reduce it from investment if it is pre, and transfer to profit and loss account if it is post. As we discussed, it is a pre-acquisition period. So cash account debited to dividend income. Then what is the second entry? Dividend income account debited to investment. Reduce it from investment. So investment account is credited. So in total, so by in a single entry, we write cash account debited to investment. For example, if the pre-acquisition period dividend received wrongly credited to profit and loss account, wrongly credited to profit and loss account, then what we do? Then means what? What is the wrong entry they recorded? Bank account debited to dividend income. The dividend income they transfer to what? Profit and loss account. What is the correct entry we have to record? Bank account debited to investment. So we have to give the rectification. What is the rectification entry? Whatever the wrong credit you give is required to be cancelled by giving it debit. So profit and loss account debited to investment account. To investment. Which profit and loss account? Holding company profit and loss account. Because the mistake was made in the holding company. We are discussing in the books of the parent company or holding company. So parent company profit and loss. Parent company profit and loss we considered in which step? Step 6. Consolidated reserves and surplus. And investment account where we consider cost of investment. Already we discussed in step 4. Step 4 from there we have to reduce it. If no entry was recorded, then record it now. Cash account debited to investment account. So it was wrongly credited to the profit and loss account by the parent company. Then you have to give the rectification. What is the rectification? Parent company profit and loss account debited to investment account. And another scenario, if the entry was already recorded, corrected. That means subsidiary company announced a dividend that was received by parent company and is correctly adjusted to the investment also. Correctly reduce it from investment also. Then no entry is required to be recorded. No more further adjustment is required in consolidated financial statements because it was already recorded correctly. Okay. So this is about what dividend. So if any dividend announced by a subsidiary company, that part is very important. You have to analyze that subsidiary company announcing the dividend out of pre-acquisition period profits or out of post-acquisition period profits. If the dividend announced out of pre-acquisition period profits, consider reduce it from cost of investment. We write the entry bank account debited to investment. If the dividend announced out of post-acquisition period profits, then credited to profit and loss account as our income, bank account debited to P&L. Then, and if no entry is recorded by holding, then record it cash or bank account debited to investment. If any wrong entry recorded by crediting the profit and loss account instead of reduce it from the investment, then we need to give the rectification entry. What will be the rectification entry? Profit and loss account debited to investment. If any entry was correctly recorded, the entry was correctly recorded, then no problem, ignore it. Okay, then that is the step 4. Okay, so we discussed up to step 4. I hope you understood. And coming to the next one, step 5. Step 5 is relating to what? Consolidated minority interest. And already we discussed minority interest stands for what? So the percentage of the shares other held by the persons other than parent company said to be a minority interest. Minority interest is calculated as minority interest share in share capital of subsidiary company plus pre-acquisition period profits of subsidiary. Pre-acquisition period profit portion already we computed in step 3, right? Analysis of reserves and surplus. From there we have to consider post-acquisition period profits of a subsidiary minority interest. Post-acquisition period profits. So that is also we discussed in step. So in step 3, so this one. Minority interest share in pre-acquisition period and post-acquisition period completely transferred to step 5 minority interest and pre-acquisition period profit share in relating to parent company that is transferred to step 4 cost of control. Then this part we didn't disturb till now. This will be transferred to step 6 consolidated reserves and surplus. If you did any wrong in the step 3, then step 4 will be wrong, step 5 will be wrong, even step 6 also will be wrong. Okay, so that's why very important step. Okay, this is what minority interest. Okay, next consolidated reserves and surplus. In consolidated reserves and surplus we consider parent company reserves and surplus. We take it from separate financial statements of holding company and holding company share in post acquisition period profit. Holding company share in pre acquisition period profits already we considered in step 4, right? And here we have to consider post acquisition period profits relating to parent company or holding company. And this is the amount we transferred to consolidated balance sheet as a reserves and surplus. And these are the six steps procedure. Okay, first one, date of acquisition and date of consolidation. Second one, shareholding pattern of subsidiary company. And step three, analysis of reserves and surplus of subsidiary company. Here, reserves and surplus of subsidiary company on the consolidation date is required to be segregated in between post-acquisition period profits, pre-acquisition period profits. Again, pre-acquisition period profits are required to be segregated in between parent portion and minority interest portion, and post acquisition period profits are also required to be divided in between parent and minority interest portion. And step 4, cost of control means calculation of goodwill or capital reserve. There we consider cost of investment less pre-acquisition period dividend received from subsidiary company. And from there we have to reduce parent company share in equity of a subsidiary company on the date of acquisition. What is meant by equity of subsidiary on the date of acquisition? Share in share capital of subsidiary company plus share in pre-acquisition period profits of subsidiary company. A pre-acquisition period profit share we take it from step 3, and the difference is the positive, that is a capital loss we transfer to goodwill. Difference is the negative, that is a capital profit we transfer to capital reserve. In share capital and reserves and surplus on the date of acquisition is not provided in the proper, consider net assets of subsidiary company on that day. And step 5, minority interest. Minority interest share in share capital of subsidiary company, pre-acquisition period profits of subsidiary company, and post-acquisition period profits of subsidiary company. That is the total minority interest. Consolidated reserves and surplus, step 6, holding company amounts. We take it from separate financial statements of holding company. Next, holding company share in post-acquisition period profits. We take it from step 3, and if you do add it, then we get consolidated amount of reserves and surplus to be shown in reserves and consolidated balance sheet. Then finally, we move on to the consolidated balance sheet. And remember, in case of consolidated balance sheet, we have to follow Schedule 3 of Companies Act 2013 only. And we have to follow this process. Okay. In consolidated balance sheet, first we have to write what? Equity and liability. So first one, shareholders one. Share capital. Consider only what? Parent company share capital. Holding subsidiary company share capital is not considered. Already we discussed, because it is subsidiary company share capital is similar to investment in subsidiary company on asset side of holding company. So both are cancelled. Okay. Reserves and surplus. We take it from step 6 and step 4. When we consider step 4, if you have capital reserve in step minority interest, directly we consider non-current liability. Think everything is non-current or current liability. Holding plus subsidiary minus any mutual borrowings we have. For example, the holding company gave a loan to the subsidiary company, and that is called as mutual borrowing. We have to reduce it from non-current liability as well as non-current assets. And the holding company sell the goods on credit basis to subsidiary company. Then that became creditor to one person and the debtor to another. We have to reduce it from current liability as well as current assets. Those are treated as intercorporate owings. And total. Next, non-current assets, non-current assets, PPE, holding plus subsidiary, intangibles, holding plus subsidiary markets. Step 4, if any goodwill we have. Non-current investment, only holding plus subsidiary, but holding related other than investment in subsidiary company. Current assets, holding plus subsidiary minus intergroup transactions we have, if any. And this is the part of consolidation procedure. Okay. And a very simple 6-step procedure. Just follow this one. You will get full marks in the final exam. Okay. Then we have some important points need to keep in mind while doing the consolidation. Before that, we do some problems relating to the consolidation. Okay. Hmm. So here XYZ Limited, then first to do second problem. XYZ Limited purchased 80% shares of ABC Limited on 1st January 2000 X1 for 1 lakh 40. And the share capital of ABC Limited on 1st January 2020 X1 was 1 lakh. The balance in the profit and loss account was 60,000. 1 minute. For example, here XYZ Limited acquired 80% of ABC Limited on what date? 11x1 for rupee 1,40,000. Okay. The issue capital. So on the date of acquisition, what is the share capital? 1 lakh. And what is the profit and loss account? 60,000. And during the year, so ended 31st December, so ABC Limited earned a profit of 20,000 and declared and paid dividend of 15,000. So here they provided pre-acquisition period profits, post-acquisition period profits. And profit and loss account on 1/1/2000 up to the date of acquisition, whatever the profits have completely covered under pre. Or what is the portion? 60,000. And the remaining coming to the current year, they earned a profit of 20,000. So that is covered under post. And they announced the dividend. And the dividend announced out of the post acquisition period profits clearly mentioned nothing but what 5,000 and pre-acquisition period profit 60. And what is the XYZ Limited share? 80%. 80% means 48,000 and minority interest 12,000. And here 80%, 4,000 and 1,000. Yeah, 4,000, 1,000. Then what will be this is the analysis of what reserves and surplus. And show the entry how the dividend should be recorded in the books of XYZ Limited. And in the books of XYZ Limited, first, when the dividend received, you need to check whether it is pre or post. And clearly mentioned it is provided at a post acquisition period. So that is the income relating to the holding company only. They noted it as what? Bank account debited to dividend income account. How much? 15,000 into 80%. Out of the total 15,000, they get only 18%. Means what? 12,000. And the later, this dividend income is transferred to what? Profit and loss account. Dividend income account debited to profit and loss account. And what is the minority interest part? And on 1st January as well as on 31st December. So minority interest. Minority interest means minority interest share in share capital of subsidiary company. What is the share capital? 1 lakh. 1 lakh into 20%. 20,000. And what is the pre-acquisition period profit share? Nothing but 12,000. This is 32,000 minority interest on the date of acquisition. And after that, in post-acquisition period, they are getting the share 1,000. So total 33,000. This is the minority interest on 31st December X1. 31st December X1. And minority interest may vary with the change in post-acquisition period profit. But coming to the cost of control, there is no change. Cost of control will be calculated only on the date of acquisition. And next one, also please check whether there should be any goodwill or capital reserve. So goodwill or capital reserve is calculated by using step 4 if you remember, cost of control. What is the uh, cost of investment? So for how much amount they purchased? 1,40,000 and minus. So XYZ Limited share in share capital. On the date of acquisition, what is the share capital? 1 lakh. Out of that, they acquired 80%, nothing but 80,000 and pre-acquisition period profit. Pre-acquisition period profit share relating to XYZ Limited 48,000. Then, so here 80 plus 48, 1 lakh 28. 1 lakh 40 minus 1 lakh 28. Nothing but what? 12,000. Positive. Nothing but capital loss. And that is nothing but what? Goodwill. Nothing but what? Goodwill. Okay. So here the goodwill part is 12,000 and minority interest on the date of acquisition 32. Minority interest on 31st December is 33,000 and this is the journal entry and we wrote it as bank to dividend income. The second entry dividend income to profit and loss. And in combination they note single entry bank account debited to profit and loss account. Okay, that is the part. That is the second question. Okay, and And one more thing is one of the important topic here we discussed before going to the next problem, revaluation of assets and liabilities. Revaluation of assets and liability. And remember, the revaluation happened on the date of acquisition. On the date of acquisition, we have the impacts of what two. One is either increase in value or decrease in value. Increase or decrease in value. And what is the impact of the increase or decrease in value? And we discuss it in AS10, AS10 PP. In case of increase in value, we transfer to revaluation surplus. In case of decrease in value, we reduce it from profit and loss account. But anything, any impact should be considered in pre-acquisition period portion. And it means in this step three, while doing the analysis of resource and surplus, any impact relating to the revaluation of assets of a subsidiary company, revaluation of assets of subsidiary company on or before the date of acquisition. On or before the date of acquisition, you have to consider it in the pre-acquisition period part. We have to consider it in pre-acquisition period part. But remember, due to the change, there is a change in value of the asset, and due to that, there is a change in depreciation. Normally, so this revaluation normally happened only for the purpose of what consolidated financial statements. Because while purchasing the shares of a subsidiary company, we purchase it at a market price. We purchase it at what market price or fair value available in the market. But coming to the standalone financial statement, yeah, holding company is preparing its standalone financial statement, subsidiary company preparing its standalone financial statement. And in subsidiary company, they may follow revaluation method or not. They may follow cost model. Normally, in the general scenario, they follow what cost model. So revaluation impact is not provided in the individual financial statements of subsidiary company. Okay. So, but the revaluation of assets we have to consider for the purpose of our consolidated financial statement. So, you need to check whether the revaluation is done on or before date of acquisition or after the date of acquisition. If it is done on or before the date of acquisition, consider that impact in pre-acquisition period profit. But due to that, any change in depreciation, any change in depreciation, either depreciation has been increased, nothing but additional depreciation is required to create, or depreciation has been decreased. Any change, we have to provide it in post acquisition period profits. Impact is provided in a post and reduce it from or reduce it or add in the profit and loss of post acquisition period. So remember, revaluation effect. For example, the asset value on 1/4/2000 X1 is at 10 lakhs, and 10% depreciation has been provided around, so means what, 9 lakhs. This is the subsidiary company financials. But on 1/4/2000 X1, date of acquisition is also 1/4/2000 X1. On that day, asset has been revalued as 12 lakhs. Asset has been revalued as 12 lakh. But in the standalone financial statement, they consider 9 lakh only. They follow the cost model. They follow the cost model. But for the purpose of consolidated financial statements, you have to consider revalued figures of the assets and liabilities of a subsidiary company. As per that, there is an increase in the value of the asset is how much? 2 lakhs. But along with that, on this 2 lakh, the depreciation is required to be provided for the whole year. In AS10 PPE, if any revaluation happened, then the depreciation is required to be provided on the based on revalued figure in the subsequent period. But here you provided 10% only on the cost or carrying amount of that asset, but additional cost is added here. Additional amount added here 2 lakh. On that also you have to calculate depreciation. Nothing but for 10%, nothing 20,000. This 2 lakh will be added to pre-acquisition period profits um, because what the revaluation happened on the date of acquisition on or before. If anything happened, increase or decrease in value is a adjusted pre-acquisition period profit. But this additional depreciation is a decreased from profit and loss accounting post-acquisition period profits. Profit and loss account in post-acquisition period profits. And remember, this is very, very important. And one more thing is same relating to the decrease in value of an asset. In case of decrease in value, we have to reduce it from pre-acquisition period profits because there is a decrease in profit, and that depreciation will be added back to the profit and loss account in post-acquisition period. And sometimes revaluation is a happen. For example, 14x1, 31st March x2. This is the on 1st October 2000 x1 is the date of acquisition. Date of acquisition. And the book value of the asset is 10 lakhs, and depreciation has been provided, and the book value here is 9 lakhs. On this day, revaluation happened, and as rupees 12 lakhs. So the revalued figure on the date of acquisition is provided, and the same concept we have to follow. Increase in value, we adjusted it in pre-acquisition period profits. Decrease in value, we adjusted it in pre-acquisition period profit. But due to the revaluation, whatever the impact we have will be considered in post. And here, this is covered under pre, this is covered under post because this complete part is belongs to before acquisition, covered under pre. But in the question, they provided for book value on the at the beginning of the year, not on the date of acquisition. And if you remember, book value on the date of acquisition is provided. No doubt. 10 lakh, we compare the book value with revalued amount. 2 lakh will be considered as an impact. We provided it in P. But the problem is, revalued amount is provided on the date of acquisition. Book value is provided at the beginning of the year. As per AS-10, if any revaluation is happened, remember, so first calculate what is the book value on the date of revaluation. Then compare it with the revalued figure and then consider the difference amount, either revaluation surplus or transfer to profit and loss account. So without calculating book value on the date of acquisition, don't compare. And majority of the students did a mistake relating to this point. This is very, very important point. Okay. So this is what revaluation. The asset is revalued on or before date of acquisition. Consider the impact of revaluation in pre-acquisition period profits. Nothing but in step 3. Increase in value. Revaluation surplus means added to pre-acquisition period profit. Decrease in value, reduce it from profit and loss in pre-acquisition period profit. Considered in pre. But the impact of depreciation should be considered in first. No, remember, no entry recorded in separate financial statement either by parent or subsidiary. The impact is considered only for what purpose? Consolidated financial statement purpose only. And this is the year on 1/4/2025 date of acquisition. P Limited PPE is revalued to 3 lakh. Book value on this day is 4 lakh 50. And there is an increase of 50,000. That increase in value added to pre-acquisition period. On that 50,000, you need to provide the depreciation for entire year. 50,000 into 20, 10,000. That additional depreciation we have to charge, and we reduce it from profit and loss account in cost. And here, this is important point. On 1/4/2025 to 31st March 26. On 1st October, you purchased 80% of the shares of B Limited. PP on 1st October, 3 lakh. But remember, book value on what date? 1/4/2024. Sorry, 1/4/2025. Remember? Sorry, 1/4/2025. 1/4/2025 is provided. Book value on the date. Okay, 1/4/2025. So you need to charge the depreciation and calculate book value on 1st October 2025 and compare it with 3 lakhs. Then we get what is the impact of revaluation and is provided in 3. And the impact of depreciation is provided in post. The concept is same, but the calculation of increase or decrease in value will be the difference. Okay, I hope you understood. Okay, this is about what revaluation. Okay, so we'll do one problem. And this problem is very, very important. And sometimes already we discussed if the share capital and pre-acquisition period profits relating to subsidiary company on the date of acquisition is not provided, then what we do? And we have to consider net assets, right? And here, X Limited acquired 70% of equity shares of Z Limited as on 31st March 2000 X1 at 70 lakhs. Following information is available from the balance sheet of Z Limited on 31st March X1. Remember, here the balance sheet is relating to what? On the date of acquisition. On the date of acquisition balance sheet. So here PP is provided, investment, current assets, loans and advances, 15% debentures, current liability, and this is the balance sheet of Z Limited. Here Z Limited is nothing but what? Subsidiary company. Okay. So here what? X Limited acquired 80% shares of the Z Limited. On what date? 31st March X1 at the rate 70 lakh. At the rate 70 lakh. And Z Limited related share capital and reserves and surplus on the date of acquisition is not provided. And they provided only assets and liabilities. Then we have to calculate what is the net assets. What is the net assets? And here, what is the net assets here? So net assets means what? Total assets minus outside liabilities. So 120 PPE and 55 plus 70 plus loans and advances 50 minus 90 minus 50. So plus 55 plus 50 plus 15 minus 90 minus 50. How much amount? 120 is there. And 120 lakhs. Net assets. Out of that 80%. How much amount is there? 96 lakhs. Correct? Into 0.8. 96 lakhs. And then coming to the problem. The following revaluation has been agreed upon, and the PP is up by 20%, investment is down by 10%. Okay, and when the revaluation is provided, and while calculating the net assets, and remember this point is very very important. Don't consider book value. You have to consider revalued figures. You have to consider revalued figures. So 120 plus 10%, 20%, 144, and the investment down by 10%, decreased by 10%. So 55 minus, so 55 into 90% direct, 49.5. This is 70, 15, 90, 50. There is no change. So 144 plus 49.5 plus 70 plus 50 minus 90 minus 50. How much? And out of that, 80% share. 80, sorry, 70% share. Out of that, 70% share. So 96.95. Okay. So here we have the problem 144, 49.5. So here 138.5. And how much amount we have? 96.95. 96.95. Right. Okay. Then Z Limited declared and paid dividend at 20% on equity shares on 31st March. Face value 10 rupees. X Limited purchased each share at 20%. But here the problem is for calculating the dividend, how many shares acquired by the Excel Limited is not provided. Just percentage has been mentioned, but a number of shares is not mentioned. So because the dividend rate is always applied on the face value of the share, face value paid up value of the share. Here face value is provided. Number of shares into face value into 20% you have to consider. But we have one data, nothing but at what price you purchase these shares? 70. And each share was purchased for 20 per share. So 70 lakhs by 20. How many shares you purchased? 3 lakh 50. 3 lakh 50 into each share, face value of the share is 10 rupees. So 35 lakhs into 20% is the dividend. How much dividend you provide? You get 7 lakh. How much? 7 lakh. Any dividend relating to the pre-acquisition period. The dividend relating to what 31st March X1 means what? Pre-acquisition. That is reduced from cost of the investment. What is the cost here? 70 lakhs. 70 lakhs minus 7, 63 lakh. There, how to do? What is the cost of investment? 70 minus pre-acquisition dividend 7, 63 lakhs is the minus. So X Limited share in net assets. And net assets are required to be calculated at revalued figure. What is the share in net assets? 96.9. And we have the negative figure. How much amount we have? 33.95 negative. And negative means what? Capital profit. So we transfer to capital reserve. We transfer to what? Capital reserve. In the absence of the share capital and reserves and surplus of subsidiary company on the date of acquisition, simply consider net assets of the subsidiary company on the date of acquisition for the calculation purpose. Okay, this is the one. Okay, so that is relating to revaluation. Okay, and another one, then we'll discuss fifth question and one of the important and variety question we. So generally we can expect this type of question in a case-based scenario. Normally we can expect in case-based scenario. So listen carefully. Variety Limited hold 46% of paid up share capital of VR Limited, and the shares were acquired at a market price of 17 rupee per share. And the balance of the shares of VR Limited are held by foreign collaborating companies. Okay. So here Variety Limited. So VR Limited shares hold by Variety Limited. How much? 46% held up. And at each share is 17 rupee per share. And the remaining what? 54% held by foreign collaborating company. And foreign collaborating company, memorandum of understanding has been entered in between foreign company provided the following. The shares held by foreign company will sold to Variety Limited. These shares will sold to Variety Limited. But at what price? The price per share will be calculated by capitalizing the yield at 15%. Yield at 15. Yield means return. What is meant by yield? That is provided here. Yield for this purpose would mean 40% of average of pre-tax profit for the last 3 years, which were 30, 40, 65. So average profits of last 3 years into 40%, and at the 15% you are getting what yield. So here, what is the average profits? So 30 plus 40 plus 65 by 3 by 3. So how much? 30 plus 40 plus 65 by 3. 45 lakhs. 45. And 40% of average profits. 45 into 40%. 18 lakhs. And yield is equal to, so at the 15% we have to capitalize it. Right? 18 by 15%. So by 15 into 100. Nothing but what? 120 lakhs. Yield is equal to what? 120 lakhs. This is the first point. The actual cost of the share. So this is the first point. But here the shares held by foreign company will sold to Variety Limited. The price per share will be calculated by capitalizing this one. And the price per share. And here the total value of the company we get once in 120 lakhs. And how many shares held by VR Limited? So VR Limited number of shares are how many? So here the VR Limited number of shares are 2 lakh. So number of shares 2 lakh. Then rise per share. 120 lakhs by 2 lakhs. Nothing but 60 rupee per share. That is what at what price they purchased. 60 rupee per share. Okay. And actual cost of the shares to foreign company was 5 lakh 40,000 and the profit that would accrue to them would be taxable at an average rate of 30%. Tax payable will be deducted from the proceeds and the right limited will pay it to the government. Out of the net consideration, 50% will be remitted to foreign company immediately and the balance will be unsecured loan repayable after 2 years. And here, the above agreement was approved by all concerned for being given effect on fund for 2000 extra. Total assets 1 crore. And it decided to write down the PPE by 1 lakh 70. The 1 crore minus 1 lakh 75. This is the revised total assets. And current liability 20 lakh. So minus 20 lakh, we get what? Net assets. We get what? Net assets. And the paid up share capital of ER Limited is. And what is the question? Goodwill or capital reserve? How to calculate the goodwill or capital reserve? First, we have to calculate cost of investment. First, 46% they acquired at 17 rupee per share. 17 rupee per share. Out of the 2 lakhs, 46% of the shares means 92,000 into 70. At what price they get? 15 lakh 64,000. And the next 54% అంటే 2 lakhs into 54%. Each share they get what? 60 rupee per share. 64 lakh 80,000. So plus 15 lakh 64,000. How much? 80 lakh 44,000. And from there we have to reduce what? Net assets of ER Limited. 100% because on this day entire 100% hold by VR Limited, Variety Limited, because 46% directly, after that 56% acquired from Variety, acquired from foreign collaborating company. What is the net assets we computed? So 1 crore, 1 crore. Out of that, property, plant and equipment write down by 1,75,000 minus what is the current liability we have? 20 lakhs. 78 lakh 25,000. So 80 lakh 44,000 minus 78 lakh 25,000. How much? 2 lakh 19,000. Positive figure. So this is what? Goodwill. 2 lakh 19,000 is the goodwill. Okay. What is the answer? 2 lakh 19,000. But in this question, and one more question they may ask. So how much amount is remitted and how much amount will be transferred unsecured loan? So that's why I told you for MCQ purpose, this is very, very important question. Okay. And don't skip this question, try to do once. And one of the important question we have. Okay. And then we'll do the seventh question. H Limited acquired 3,000 shares in S Limited at a cost of 4,80,000 on 31st July. The capital of S Limited consisted of 5,000 shares of 100 each, fully paid up. The profit and loss account of the company for the 2000 X1 showed opening balance of 1,25,000 and profit for the year was 3 lakh. At the year end, it declared 40%. Record the entry in the books of H Limited in respect of the dividend. Assume that profit is accruing evenly and calendar year as financial year. So first, what is the case? Here, H Limited acquired 3,000 shares in S Limited at 4 lakh 80,000. 4 lakh 80 on what date? 31st December X1. 31st December, 31st July X1. And it means out of the period, what is the financial year? They follow the what? Calendar year as financial year. That means 1/1 X1 to 31st December. Out of that, 31st July extra. This is covered under pre, this is covered under post. The pre period is nothing but uh, 7 months, and the remaining 5 months covered under what? Post. Okay, and this is the stage. And here, the profit and loss account of the company for the year showed opening balance P and L 1,25,000 is there, and the profit for the year 3 lakh. Generally, the profits are accrued evenly throughout the year, and we have to apportion it on time basis. So 3 lakhs by 12 into 7, 1 lakh 75,000, and the remaining 1 lakh 25,000. The overall pre-acquisition period profits are 3 lakhs, and the post-acquisition profits are 1 lakh 25. This is the post, and this is what pre. And here, company announced the dividend, declared the dividend of 40%. What is the dividend? Dividend is nothing but, so మొత్తం total how many shares? 5,000. So 5,000 into 100 into 40%. Say 2 lakh is the dividend declared. 2 lakh. But out of that 3,000 shares, and H Limited held 60%. H Limited held what? 60%. Then what is the record the entry in respect of dividend? The question is, the dividend is provided during the dividend is provided during the 2 lakh is provided out of in the current year, means out of the pre-acquisition post-acquisition period profits only, the current year profits only. But the problem is the current year profits covered under pre as well as under post. For example, case 1, first we provide the pre and the later we provide the post. First we use the entire pre profits for the current year only. Don't disturb this 1,25,000. Don't disturb opening balance. And they clearly mention the dividend is provided out of the current year profits only. And even Schedule 3, while discussing the financial statements of the company, one topic is that dividend related. Dividend is always provided out of the current year profits first. And if it is not available, then we go to the previous year profits or reserves and capital, reserves and surplus. So first we use the current year profits here. But the problem is first out of the pre and later out of the post. It means pre-acquisition period profits completely 1,75,000, and the remaining 25,000 is provided out of post, because the total dividend is equal to how much amount? 2 lakhs. Total dividend is equal to how much amount? 2 lakhs. And here out of that 60%, H Limited share is how much amount? 60%. 60% only belongs to H Limited. So 1,75,000, sorry, into 60, 1,05,000 plus 25,000 into 60, 15,000. This is true. So 1,20,000. How the entry recorded? We write the entry bank account debited 1,20,000 to pre, if any dividend provided out of the pre-acquisition period profits, reduce it from cost of the investment to investment 1,05,000 to profit and loss out of the post-acquisition period, transferred to profit and loss. Okay. Then case 2, complete use post first and later use pre. Post is how much amount? 1,25,000. Pre is how much amount? The remaining 75,000. And out of that, our part is 50%. So 1,25,000 into 60, 75,000. ఇంకా remaining minus 1 lakh. Total dividend we get, so 45. Nothing but 1,20,000. In that case, we write the entry what? Bank account debited 1,20,000. First we use what? Post. Nothing but profit and loss account 75. To investment 0.45. 0.45. Okay. Case 3, and use the pre and post in time ratio. In time ratio. Okay. Use the pre and post in time ratio. And here 1,20,000, how you get? So 1,20,000 into 7 by 12, nothing but 70,000 from pre, and 1,20,000 into 5 by 12. So 50,000 is from post. So we write the entry bank 1.2 to investment 70,000 to profit and loss account 50,000 to profit and loss account 50,000. These are the scenarios we have. Okay. So first we may use completely pre, and then later we move on to the post. Or first we may use complete post. Later we move on to the pre. Or divide the provide the total dividend out of the pre and post in the time ratio. Think but in 7 is to 5. 7 is to 5. And this is the thing we have. Okay. And this is also one of the important question. And do it once. Okay. And these are the exercise problems we have. Okay. And coming to the problem number 12. And here we have the bonus issue. On 31st March 2000 X1, minute. On 31st March 2000 X1, P Limited acquired 1,05,000 shares of Q Limited for 12 lakh. So, and what did they acquire on 31st March X1? And the position on that day, here net assets are given. Here what? Net assets are provided. Net assets and, net assets are provided. And some data, total data is provided. And total shares is how much? 1 lakh. So, 1 lakh 5 by 1,50,000 into 100. How much amount? 70%. P Limited, 30% is relating to a minority interest. Okay. And P Limited and Q Limited data has been provided here. This is the complete data we have. And here, complete before bonus issue status is provided relating to Q Limited. And directors of a Q Limited so made bonus issue on 31st March 2000 X3 in the ratio of 1 equity share of 10 each fully paid up for every 2 shares held. So means it's 1,50,000 into 1 by 2. That means 75,000 shares have been issued as a bonus shares. Bonus shares issued out of post acquisition period profit by using general reserve. To calculate cost of control, minority interest, consolidated profit and loss in each of the following case before bonus issue, immediately after bonus issue. And first of all, for calculating the cost of control or minority interest, you have to prepare analysis of reserves and surplus of subsidiary company. Okay. So already we recorded what is the uh, percentage held by P Limited in the shares of Q Limited and minority interest. Shareholding pattern was discussed. And analysis of reserves and surplus of Q Limited and pre post in post general reserve profit and loss account. And here one more important point is this is relating to before bonus issue and post after bonus issue what? General reserve, profit and loss account. Okay. And here pre-acquisition period on the date of acquisition already we have pre-incorporation profits and profit and loss account. So pre-acquisition period is how much amount is there? 30,000 plus 60,000. 90,000 profits we have and no general reserve we have. And if the general reserve is given in the problem, General reserve is not available on the date of acquisition. General reserve is not available on the date of acquisition. Okay. And profit and loss account is relating to the Q limited is how much? On 31st March, 4,20,000. Out of the 4,20,000, out of the 4,20,000, 60,000 belongs to pre 60,000. And the remaining 3,60,000 belongs to what? Post 3,60,000. And 19 lakh 5,000 relating to uh, general reserve we have. And the general reserve is not available on the date of acquisition, so completely we consider it in post. So 19 lakh 5,000. And we provided what? Bonus shares. The bonus shares are provided out of post-acquisition period profits, and that too by using general reserve only. What is the bonus shares? 75,000 bonus shares have been issued in one equity share for 10 each. One equity share for every two equity shares held. How many equity shares we have? 1,50,000. Already we have the data. 1,50,000. So 1,50,000 into 1 by 2. 75,000 into 10 rupee per share. Is how much amount? 7,50,000 bonus shares. So 7,50,000. After bonus shares only we have to consider. Then what is the remaining part? 90,000 and 19 lakh 5,000, 3 lakh 60 and 9, 19 lakh 5,000 minus 7 lakh 50,000. 11 lakh 55,000 and 3 lakh 60. And in this we have to calculate P limited and minority interest part. Okay, this is the amount. So here pre-acquisition period profits completely 90,000. And post-acquisition period profits we have to divide in between pre and post. And general reserve 19 lakh 5 and the bonus shares we calculated 7 lakh. General reserve after bonus issue 11 lakh 55. We have to compare and profits are nothing but 3 lakh 60, 3 lakh 60 and out of that P limited share in pre and in post. At the before bonus shares, this is the post after bonus shares we have to calculate. And pre-acquisition period profits relating to the P limited. Consider it in cost of control, right? So how much amount is it? 63,027. And here we consider both. So 19 lakh 5,000 into 70. 13 lakh 33,500. 19 lakh 5,000 into 5 lakh 17. And 2 lakh 52. 1 lakh 8,000. And 11 lakh 55,000 into 70. 3 lakh 45. Okay. And cost of control we have to calculate. First one is cost of control. Cost of control is what is the cost we acquired? So 12 lakhs. 12 lakhs minus 1 lakh 5,000 shares. Nothing but 10 lakh 50,000 plus what is the pre-acquisition period profits relating to here? 63,000. So 12 lakhs minus 10 lakh 50,000 minus 63. How much amount is that? 87,000 goodwill. 87,000 goodwill. And minority interest. Minority interest is nothing but so out of the 1,50,000, 1 lakh 5,000 shares are relating to sorry, okay, and this is what before bonus issue. And one more thing is you have to calculate after bonus issue also. After bonus issue, there is no change in cost because we are getting the bonus shares at free of cost. Bonus shares are generally issued at free of cost. So 10 lakh 50,000 share capital, but there is a change in number of shares. Correct? There is a change in what? Number of shares. So 1 lakh 5,000 into 1 by 2. So 52,500 shares we get and 5 lakh 25,000 plus 63,000 free. And this is what? So 12 lakhs minus 10 lakh 50,000 minus 5 lakh 25,000 minus 63,000 and 4 lakh 38,000 negative. Nothing but what? Capital reserve. So nothing but what? Capital reserve we have. So 4 lakh 38. So here cost of control. First, before the bonus issue, we have goodwill. How much amount is there? 87,000. And after the bonus issue, we have 4 lakh 35, 38,000 is nothing but what? Capital reserve. Capital reserve. And minority interest simple. Minority interest share in share capital plus pre-acquisition period profits plus post-acquisition period profit. And this part completely added to the and after bonus issue plus pre-acquisition period profits we added. So minority interest share capital is after bonus issue, capital profit and overall revenue profit. Yeah. And same way for and before bonus issue, this is the one. Okay. So this is the problem before bonus issue and after bonus issue. What is the case? Okay. And here this is what complete consolidation problem. Simple and complete consolidation problem. And we'll discuss this one also. H Limited and S Limited provide the following information as at 31st March 2000 X2. And H Limited data is provided, S Limited data. In H Limited, we have on asset side 8,000 equity shares of S Limited. How many equity shares are there? 10,000. Out of that 80,000 equity shares means H Limited hold how much percentage of S Limited? 80%. And the minority interest is 20%. Okay. So H Limited 8,000 means 80%. Minority interest remaining 2,000. Nothing but what? 20%. At what price they get? 1 lakh 26,000 cost. Okay. On what date? 31st month. H Limited acquired share. Sorry. On what date? 1st July. So here 31st March X2 means on 1st July X1 is the date of acquisition. This is the date of consolidation. This is covered under pre. This is covered under post. In pre, how many months covered? April, May, June, 3 months. And the remaining 9 months covered under post. Okay. And so this is the stature. And on the date of acquisition, what is the profit? 30,000. And first, the total profits of the company. So S Limited profits is how much? 40,000. 40,000. And out of the 40,000, 30,000 profits are available on 14x1. Out of the total 40,000, 30,000 profits are complete balance of profit and loss account on 14x1 is 30,000. And in the current year, they earned how much profit? 10,000 only. Correct. Total profit they earned during the period 10,000 only. So 10,000 into 3 by 12, 2,500, 2,500, 7,500. So total pre-acquisition period profits 32,500 and post-acquisition period profits 7,500. 7,500. And next, we have to calculate what? Cost of control. Cost of control, first we consider cost of investment. At what price we purchased 1,26,000 minus H limited share capital. How many share capital is 80,000 minus pre. Out of the 32,500, what is the share? 80%, 26,000. So 1,26,000 minus 80,000 minus 26,000. Nothing but 20,000 is the goodwill. And what is the minority interest? Share capital 20 and the pre-acquisition period profits. So 32,500 minus 26,000. 6,500 and post-acquisition period profits. 7,500 into 20, 1,500. 1,500. So how much amount is there? So 20,000 plus 6,500 plus 1,500. 28,000 is the minority interest. Okay. And the consolidated reserves and surplus means first we have to consider H limited. H limited is how much? 50. And H limited share in post acquisition period profits. So 7,000 out of 7,500, 1,500 belongs to pre minority interest, and the remaining 6,000 belongs to P limited. This is the part. Okay. So okay. So this is what shareholding pattern. And coming to the first, we note the year, and goodwill we computed is how much? 20,000. And minority interest we computed as 28,000 minority interest. And reserves and surplus, consolidated reserves and surplus is how much? 56,000. Okay. And the remaining part is common. And share capital, only equity shares of holding companies considered. Reserves and surplus, step 6. And minority interest, step 5. And trade payable, P limited plus H limited plus S limited, PPE, H limited plus S limited. Intangible asset is nothing but what? Goodwill. Step number 4, cost of control and current assets, H limited plus S limited. Okay, I hope you understood. And just follow the procedure and note down the each and everything on step by step. At last, write down what is the consolidated balance sheet. And remember, coming to the balance sheet, and you will get up to 4 to 5 marks. And coming to the notes to accounts, you will get around 4 marks. And for working notes relating to the calculation part, these steps, my calculation analysis of reserves and surplus, cost of control, minority interest, and consolidated reserves and surplus. These are getting the more marks on an average. 6 marks you are getting. Okay, 6 to 7 marks. So total 14 marks maybe. Okay, but this is the simple question. Generally, the marks allotted is that. Okay, so next we'll do one more problem relating to the 16th problem, and before going to the 16th problem, one more point we have to discuss is nothing but stock reserve. Stock reserve. And simply, stock reserve means what? After getting the control, the parent company sold the goods to subsidiary company by adding some percentage of loading. Some percentage of loading. And it means as a group, parent and subsidiary treated as a single entity. Parent company is preparing its separate financial statement or standalone financial statement. In that case, they show the subsidiary company as a debtor. Subsidiary company show its individual financial statement. There they show the parent company as a creditor. But while preparing the consolidated financial statement, parent and subsidiary treated as a single entity. So in that case, we didn't have the data. We have the debtor on one side and the creditor on another side, and both are relating to same amount. And those are required to be eliminated. That what we consider. That what we discussed as it as intercorporate owings. Those are eliminated. And another point is, if any goods is sold by parent company to subsidiary or subsidiary to parent company, then at the buyer's premises, any unsold stock we have, and that unsold stock belongs to the group only. Actually, they didn't sell any product to the outside of. So they sold from one person to another person. Both are belongs to the same person. So, and here actually there is no transaction. When we consider one item as one element as a transaction, when it is exchanged with another party or who is outside the entity. But while preparing the consolidated financial statement, parent and subsidiary treated as a single entity. Okay, so that's why we have to show that unsold stock, if anything, available at the buyer at the cost price only. But seller transfer the goods at what invoice price. So some unrealized profit was included in that invoice price, which is required to be eliminated while preparing consolidated financial statement. But this concept is not required to be considered while preparing individual or its standalone or separate financial statements by parent or subsidiary. We have to consider this topic or even before topic revaluation only in case of consolidated financial statement, not in case of separate financial statement. Okay. So what we do, simple thing, and just verify. And first of all, unrealized profits are included. Who collect the profits? Seller. And the unrealized profits are included in seller's profit and loss account. Seller's profit and loss account. But stock is lying at buyer. For example, parent company sold the goods to subsidiary. Entire goods sold by subsidiary company. There is no problem because 100% goods are sold. There is no unsold stock on the date of consolidation. No need to eliminate unrealized profit. Our subsidiary company sold goods to parent company, and parent company sold 100% goods to the customer. Then no need to eliminate unrealized profit and no need to consider stock reserve concept here. The problem is if the buyer is lying with some unsold stock. In that case, simple thing is you have to eliminate unrealized profit or stock reserve. Simple entry is nothing but seller profit and loss account debited to stock account. Seller profit and loss account debited to stock account. Who is the seller? The seller is the parent company. Parent company profit and loss account debited to stock account. Parent company profit and loss account, we consider it in step 6, consolidated reserves and surplus. Stock, consolidated stock. In consolidated balance sheet, holding stock plus subsidiary stock minus stock reserve because stock is credited. If the subsidiary company is the seller, then subsidiary company profit and loss account debited to stock account. But subsidiary company profit and loss account we consider therein analysis of reserves and surplus of subsidiary company in step 3. So we have to consider it step 3 under consolidated balance sheet. We have to reduce it from stock. Okay. So simple topic. And here A Limited acquired 80% shares of B Limited. A Limited supplied goods costing 1 lakh to B Limited at 1,50,000. And there the loading is 50,000. But this is on total goods. But out of that, what is the unsold goods part? For example, entire stock has been sold. Then no need to eliminate unrealized profit. 40% of the stock was sold and the remaining 60% lying in godown at buyer premises. Here, who is the buyer? Um, B Limited, nothing but subsidiary company. So out of the 50,000, and so here 1 lakh goods are transferred at 1 lakh 50. So stock reserve is 50,000. But out of the 50,000, 40,000 was already sold. Unsold is 60. So 50,000 into 60, 30,000 is there. It is only required to eliminate. Who is the seller here? A Limited. So A Limited profit and loss account debited to stock account and the 30,000. A Limited is nothing but holding company. Holding company profit and loss we consider it in step 6 and stock in consolidated balance sheet holding company plus subsidiary minus stock reserve we have to reduce how much 30,000. Okay. And A Limited acquired 80% shares but B Limited sold goods. Here subsidiary company selling the goods to holding company and this is called as downward. And if the holding company sell the goods to subsidiary we call it as upward. And if the entire goods has been sold no need to eliminate stock risk. If A Limited sold 40% on unrealized profit is 30,000. But we have to consider what seller's profit and loss means. B Limited profit and loss account debited to stock. B Limited profit and loss means we consider it in step 3. Analysis of reserves and surplus. So in step 3, we have to consider. This is the one. So this is stock reserve. So if one holding in a group, if holding company sell the goods to subsidiary or subsidiary to holding company, simple entry. First verify any unsold stock lying at buyer premises. No unsold stock is there. Ignore that point. If any unsold stock is there, then calculate what is the unrealized part relating to unsold stock. Then what is the journal entry? Selling company profit and loss account debited to stock account. If the selling company is the holding company, consider it in step 6. If the selling company is the subsidiary company, consider it in step 3. Okay. So that is the one. And here, this is the this is 16th, coming to the next problem, 16th one. And this is relating to the revaluation. Main point is here is nothing but revaluation. The profit and loss account of B Limited showed the credit balance of 30,000 on 1st January, out of which the dividend 10% was paid. There is nothing but this is the pre-acquisition period profits, and the dividend is treated as pre-acquisition period dividend and is reduced from cost of investment in step 4, cost of control. And A Limited credited the dividend received to its profit and loss account. But remember, pre-acquisition period dividend received by A Limited, but it is credited to P&L. It means wrong credit is given to the profit and loss account. But actually, it has to give the credit to investment account. And instead of it gave the credit to profit and loss account. You need to give the rectification. What is the rectification? Profit and loss account debited to investment. Holding company profit and loss means step 6. Investment means step 4. Okay. The plant and machinery stood at 1 lakh 50 on 1st January, considered worth 1 lakh 80 on 1st January. Remember, this is the revalued figure. Book value provided at the beginning of the year. Book value is provided at the beginning of the year. And remember that point. 1 minute. So, first, coming to the shareholding pattern. Total shares of B Limited is 2000 and A Limited held 80%, B Limited minority interest is 20%. Coming to dividend adjustment and the 10%, already I told you pre-acquisition period profit. And we have to give the rectification entry, profit and loss account debited to investment account. Coming to the evaluation. And here on, what is the date? July, okay. So here, date of acquisition and a revalued amount provided on this date, but book value mentioned here on this date. So for in case of revaluation, what is the book value on the date of revaluation? You have to calculate and compare it with revalued figure. And the difference is treated as either revaluation surplus or decrease in value transfer to P&L. That is second. First, here the data provided, book value of the asset provided on 1st January. But you require book value on what date? Date of acquisition to compute it. 1 lakh 50 minus 6 months related depreciation, you have to reduce total 20%. So means 30,000 for 6 months 15, 1 lakh 30. Revalued amount 1 lakh. What is the appreciation? 37,500. That 37,500 we have to consider it in pre. But due to the increase in value, there is additional depreciation required to create to reduce it from cost, profit and loss in cost. And then 37,500 into 20% into for the rest 6 months, 6 by 12. And that is reduce it from cost. So here appreciation 73,000 for 37,500 and coming to the here depreciation is required to be reduced. So additional depreciation we have to provide it in the post-acquisition period profits. Okay, this is very important point. And the remaining all points are common. And first point is if the dividend received, dividend provided out of the pre-acquisition period profits, but Holding company recorded wrongly by crediting to profit and loss account. First, you have to give the rectification. Profit and loss account debited. Holding company profit and loss account debited to investment account. Holding company profit and loss. We have to reduce it from holding company profit and loss in step six, and you have to reduce it from investment step four. Okay. And second one, revaluation. Any revaluation happened prior to the date of acquisition, we consider it in pre-acquisition period profits, and any changes adjustment relating to depreciation we have to consider it in post. Okay, simple thing. But here the book value of the asset provided at the beginning of the year, but revaluation happened on the date of acquisition, which was during the current year. First, calculate what is the book value on the date of acquisition or on the date of revaluation. Compare with the revalued figure, and the difference is treated as either increase or decrease and will be provided in pre. And due to that change, whatever the impact in depreciation will be provided in post. The rest is same problem, and okay, this is the one. And coming to the this is what consolidated balance sheet. I hope you understood. And max majority problems I discussed here, and on and average, till now we discussed around nine problems, and all concepts we discussed. Okay. And coming to here, consolidated profit and loss account. And in consolidated profit and loss account also, we simply follow line by line basis. So adding of each and everything on line by line basis, line by line basis. So simple thing. And here first, coming to the 17th problem. And here H Limited and its subsidiary S Limited provides the following: the sales and other income. And even in case of profit and loss statement also, we have to follow schedule 3 only. Schedule 3. So sales and other income provided, and increase in inventory and the raw material consumed, wages and salaries, production expenses and administrative expense, selling and distribution, interest and depreciation. And what is the format? And revenue from operations and other income. And next, in case of coming to expenses and cost of material consumed or cost of purchases. Second one is change in stock of finished goods and employee benefit expenses, depreciation and amortization expenses, finance cost and other expenses. Then profit before tax and minus tax expenses, profit for the year. So here H Limited sold goods to S Limited, and this is the mutual transaction during the year. We have to reduce it from sales and as well as cost of purchases. 120 lakh reduce it from what? Sales and cost of purchases. So in revenue from operations, we have to reduce 120 lakhs. And from the cost of purchases also, we have to reduce 120 lakh. Okay. And plus 20%. Those goods are sold at what? Cost plus 20%. And that means out of that, any unsold stock we have by the S Limited, and there we have to adjust what? Stock reserve. What is the adjustment? Stock reserve we have to provide. And here, unsold stock is how much? How much amount is that relating to the S Limited? So listen, inventory of S Limited included such goods value 24 lakh. 24 lakh. Cost, if the cost is 100, then what is the stock reserve? 20. Sale price or invoice price is 120. 24 lakh is the invoice price. So 20 by 120. So how much amount is there? 4 lakh. So we have to reduce it here. We have to reduce it here. So, but remember, changes in inventory means opening minus closing stock. And this amount is required to be shown as a negative in the face of the financial statement. Administrative expenses of S Limited include 5 lakh paid to H Limited as consultancy fee. But here consultancy fee we have to show it under other income. But other income and the sales are both are given in single head. So administrative expenses, and if it became expense to one person, liability income to another person. So we have to reduce it from, so revenue from operation, sales and other income, consultancy fee, and in administrative expenses also we have to reduce. And administrative expenses, selling and distribution, we consider it in other expenses, consultancy fee. And another one, mm, selling and distribution expenses of H Limited include 10 lakh, and it became part of other income of S Limited commission, And coming to selling and distribution of H Limited, expense 10 lakh. We have to reduce here 10 lakh. And from the other income, and it means sales and other income head, we have to reduce 10 lakh. And next one, H Limited hold 80% equity share capital of 1000 lakh in S Limited. Prior to X1 to X2, H Limited took credit to profit and loss account. And the proportionate amount of dividend declared and paid by S Limited for the year 2000 X1 to X2. So here dividend declaration was there, and the dividend is a declare relating to the 2000 X1 to X2, and it took credit to profit and loss account. So profit and loss account, but actually it is not transferred to the profit and loss account. We transfer it to, so cost of investment. We reduce it from cost of investment. Okay, so this is the one, and so from the sales and other income, H Limited plus S Limited minus mutual transactions. And cost of purchases, H Limited and S Limited minus mutual transactions effect. And production expenses are also required to be considered as a cost of material purchased. Employee benefit expenses H plus S Limited, finance cost, depreciation amortization H plus S Limited, other expenses H plus S plus minus mutual transactions we have. Okay, and this is also one of the important one, a uniform accounting policies. So while preparing the consolidated financial statement, so H Limited and S Limited should follow the uniform accounting policies for the like transactions and other events. If uniform accounting policies are not followed, for example, H Limited is a following FIFO method, S Limited is a following weighted average price method for the purpose of valuation of inventory. In that case, S Limited is required to restate its financial statement by converting their accounting policy in the line of H Limited in the line of H Limited. After restating or after giving the proper adjustments in the line of H Limited, we do the consolidation. Sometimes, if it is not practicable to use the uniform accounting policy, no need to restate it. Just give the disclosure regarding that fact should be disclosed together with proportionate of item which the different accounting policies have been applied. We have to mention that fact in the financial statement. Okay, and here. So uniform accounting policy is required to be followed by actually holding company and subsidiary company. Both are following different accounting policy. Then try to change the accounting policy of subsidiary in the line of holding company. After restating the financials, we have to prepare consolidated financial statements. If it is practically not possible to change that accounting policy, then mention that fact in the uh, financial statements, in notes to accounts. Okay. And coming to 18 problem. Subsidiary of B Limited provide only B Limited subsidiary is provided. So 2 years data, last year and current year data is provided, and here this is the one. And also consider, and in the previous exams, and these points exactly this problem is not given in the exam, but one point has been included. This one and this one included in the another problem. And that means the problem provided in combination of two concepts. And it's, till now we discussed what is the consolidated balance sheet, what is the consolidated profit and loss statement. And along with that, if uniform accounting policies are not followed, is clubbed with previous problems. Okay, so be careful. Also consider the following information. B Limited is subsidiary of A Limited. Both companies follow the calendar year as accounting year. A Limited value the inventory on weighted average basis, while B Limited used FIFO basis. To bring B Limited value in the line of with those of A Limited, its value of inventory is required to be reduced by 12,000 at the end of 2000 X0 and 34,000 at the end of 2000 X1. So at the end of 2000 X0, so 12,000 stock has to be reduced. Only again for 2000 X1, this became the opening stock. So if any reduction we have in the previous year, that will be added in the current year. Net impact is zero. But coming to the current year, we have to reduce 34,000. And this impact we provided in the next year. But next year is not considered in current year. We have to redraft the financials of current year only. So we consider only 34,000 data. So first we have to restate adjusted reserves and surplus because there is a change in accounting policy. If the accounting policy has been changed in the line of the holding company, we have to alter. How much amount is reduced? In 2000 X1, 12,000. Again, that amount will be reversed in the 2000 X1 as an opening stock. Kabatti, ulta, that was cancelled. In 2000 X1, 34,000 has been reduced. So 34,000 only we consider. Okay. And another one, B Limited deducted 1% of trade receivable as general provision against doubtful debt. But the A Limited is not having that policy. That's why we have to revert back. And what is the uh, provision for bad debtors? We have 8 lakh 91. This 8 lakh 91 is thousand is nothing but after reduction of the provision for bad debts. The out of the 100, 1% is the provision for bad debts. This is what 99. If it is 99, what will be the 100? And what will be the 100? So 8,91,000 into 100 by 99. 100 by 99. So how much amount is there? 9 lakh. 9 lakhs minus 8 lakh 91, 9,000. That is required to be revert back. Previously, the provision for bad and doubtful debts we reduced. Now we have to revert it back because the A Limited is not having that policy to provide the provision for bad debts. That's why it will be adjusted to the profit and loss account. So 9,000 will be added back. And another one, prepaid expenses in B Limited include advertisement expenditure carry forward at 60,000 X0, 30,000 X1, being part of the initial advertisement expenditure 90,000 X0, which is being written off over 3 years. But similar amounts of expenditure in A Limited has been fully written off in X0. So here in X0, X1, X2. Actually, B Limited did in this way 30,000, 30, 30. And what is the carry forward amount here? 60,000. 30,000 0. And this portion is 0. This is the one. But if it is A Limited, complete amount will be considered in first year itself only, not considered in the further years. So you need to follow the policy followed by A Limited. So the 30 already 60,000 carry forwarded from the previous year. 30,000 considered in previous year, 30,000 considered in current year. 30,000 we will carry forward to the next year. Whatever the amount we carry forwarded to the next year will be cancelled, completely considered in the current year as an expense. Because don't carry forward the amount to the future as A Limited is not having that policy to apportion over 3 years. So 30,000 only we have to reduce. Ultimate adjusted profit and loss account is how much? 6 lakh 59. But here the profit and loss account is not given. That's why the difference between reserves and surplus we consider. So what is the difference? What is the reserves and surplus we have? 7 lakh 14,000. And further we have to give the adjustment. So no adjustment will be required in respect of opening inventory of B Limited as that will not have any impact in profit and loss because previous year closing stock, but current year same thing will be the opening stock. Okay, and based on that we have to give the adjustment. Resource and surplus is restricted as 6,59,000, and another thing is inventory change in method we have to reduce only 34,000 and added adjustment of provisions. So then 9 lakh. And the prepaid expenses 30,000 is added. Previously we have the prepaid expenses of how much amount? So hmm, prepaid expenses of how much amount? 48,000, right? Hmm, fif- 40, sorry, 48,000. Sorry. Out of the 48,000, we have to reduce what? 30,000. And the remaining amount, 18,000 is only the prepaid expense we have to consider other in other current assets. Because 30,000 also we transfer to what? Reserves and surplus, nothing but profit and loss account. Three adjustments we have. Prepaid expense of advertisement and inventory for change in accounting policy and the writing back of provision for bad and doubtfuls. Okay. Remaining is same. And coming to the 19th question. On 31st March X1, the balance sheet of H Limited and its subsidiary S Limited stood as follows. So, what is the percentage they held? So, investment in S Limited 3,000. And the data given below. So the following information is also provided to you. H Limited purchased 180 lakh of S Limited on 31st March when the balance of general reserve and profit and loss account stood at 3000 and 1200 lakh respectively. Okay, 1 minute. And this is the one. First, coming to the shareholding pattern. So here we purchased 180 lakhs, but the total number of shares we have in S Limited is how much? 480 lakhs. 10 rupee per share is how much? 480 lakhs. So 180 by 480, 37.5% only we are getting. And it means what? After, and it means H Limited is getting the control over S Limited on 31st March X1. But after 31st March X1, one event is happening. So nothing but the company may, S Limited may issue the bonus shares. And due to that, there is an increase in share capital. And in that case, our portion also has been increased. Number of shares has been increased. So after considering that bonus shares, we have to treat. So the same thing we provided here. And in the third point, on 1st January, S Limited 3 fully paid up bonus shares for every 5 shares held out of the balances of its general reserve on 31st March X0. That means 180 lakh we purchased, 180 lakh shares. 3 fully paid up bonus shares for every 5 shares held. That means what? So 180 into 3 by 5, right? 180 into 3 by 5, 108. 108 lakh and 288 lakh. And compare this one with the share capital. Now share capital is 480 lakhs. So 288 by 480 lakhs. How much amount? 60%. So 60% by H Limited, 40% by minority interest. So 60%, 40. 288 lakh is the shares held by H Limited. That is the first one, shareholding pattern. Okay. So be careful. And here the data provided 180 lakh on 31st March. Above the data related in 31st March X1. In between that, any changes we have, generally we have the changes relating to what? Bonus shares. Okay. And on 1st April 2000 X0, nothing but what? On the date of acquisition itself. S Limited declared dividend at 20% for the year. On 31st March X0, they declare, means is relating to what? Pre-acquisition period, and we have to consider it in step 4, reduce it from cost of investment. But H Limited credited dividend received by it from profit and loss account. So wrongly credited to P&L. So we have to write the entry H Limited profit and loss account debited to investment. H Limited profit and loss account means step 6. Investment means step 6 and investment means step 4. You have to reduce it from so cost of control as well as so consolidated reserves and surplus. So here we have to reduce here uh, dividend received. How much amount? 360 investment. And in the consolidated reserves and surplus also we have to consider. Consolidated reserves and surplus we have to reverse it. Okay. And next. On 31st March 2000 X1, all the bills payable in S Limited balance sheet for acceptance in favor of H Limited. But on that day, H Limited held only 45 lakhs of these acceptance in hand, and the rest have been endorsed in favor of its trade payable. And in case of trade payable, what we do? H plus S. And in case of trade receivables also, H plus S. And we have to reduce mutual owings or intercorporate owing. But intercorporate owing is nothing but actually the total acceptance in favor of H Limited or relating to the S Limited. Out of that, they held only 45 lakhs. So 45 lakhs is reduced from both trade payable as well as the trade receivables as elimination of intercorporate owings. In data, in trade payable, we have to reduce it from bills payable. In trade receivable, we have to reduce it from bills receivable, 45 lakhs. And on 31st March X1, S Limited inventory include goods which it had purchased for 100 lakh from H Limited, which made it a profit of 25% on cost. Out of the what is the total goods? 100 lakhs they have into 25 by 125. correct? So 100 into 25 by 125, nothing but what? 20 lakhs. 20 lakh is reduced from what? Selling company profit and loss account. What is the entry? Selling company profit and loss to the stock account. What is the selling company here? H Limited. Selling company here is nothing but what? H Limited. H Limited profit and loss account, we consider it in consolidated reserves and surplus, that we have it in step 6. And in consolidated balance sheet while preparing it, nothing but. So in the reserves, consolidated stock, coming to the inventory, we have to reduce here. H Limited stock plus S Limited stock minus unrealized profit what is. And in the consolidated reserves and surplus also we have to reduce. So unrealized profit reduced from consolidated reserves and surplus. Okay. Selling company profit and loss account debited to consolidated stock account. Okay. And this is the one. And the rest is not required. And max all models we covered here. Max. Okay. And just remain and on and average we covered around 10 problems in this session. 10 problems, and just to follow the sessions and try to complete the whole video without any skipping. Max and on and average 100% chapter is completed, and remember we covered only AS-21, and 23 and 27 we'll discuss it in another session. So we'll discuss it in another session. Just to follow this video, and we completed total topic relating to the AS-21 consolidated financial statement, and this topic is enough. But after completion of the video, don't forget to give the comment how you liked it, and also please share it to your friends. And one more thing is, do the practice of all these problems simply by don't live by listening the after. Please do the practice of these all problems. If you have any doubt, just uh, give me a comment below the video or join my Telegram channel, and the link is provided in description. And you have any doubt, just connect me through the Telegram channel. I will upload this one and this one in the Telegram channel, and from there you can download it. Okay. I hope you enjoy the session. Okay. Thank you very much. Bye bye.